Something happened in the silver market over the last 30 days that most investors completely missed. Not because the information was hidden, not because it was buried in some obscure report, but because the way the story was told made it nearly impossible to understand what was actually happening beneath the surface. The headlines gave you the drama, the talking heads gave you the emotion, but nobody gave you the structure. And today, that changes. Stay with me through this entire analysis, because what we are going to cover is going to completely reshape the way you look at silver for the rest of this year. Before we go any further, if you are new here, hit that subscribe button right now. This channel, Element Axis, exists for one reason and one reason only: to give you real analysis that is grounded in data, built on structure, and designed to help you think for yourself, rather than depend on someone else to tell you what to do with your money. The people who subscribe and stay are the ones who stop being surprised by market moves because they learned to read the setup before the move happened. Hit subscribe, drop a comment below telling me where you're watching from, and let us get into the most important story in the commodity market right now. Silver just gave every investor in this market one of the most violent and revealing price sequences in recent memory. If you're only measuring it by where the price is sitting today, you are looking at one frame of a much larger film and calling it the whole movie. To understand what is actually happening, you need to go back to January 29th of this year. That was the day silver printed an extraordinary peak near $121 per ounce. Think about that number for a second. $121 for a single ounce of silver. The metal that most financial advisors have spent decades dismissing as the cheaper, less prestigious cousin of gold, sitting at $121 per ounce. That was the high. 8 days later, on February 6th, that same metal crashed down to $63.85. That is a decline of 47% in 8 trading sessions. Nearly half the value of silver erased in barely over a week. If you had $50,000 in silver exposure at the peak, you were looking at around $23,500 left by the time the crash hit its low. That is the kind of move that defines portfolios and haunts investors for years if they do not understand what actually drove it. And that is exactly where the mainstream narrative failed everyone who was paying attention. They called it a bubble. They said it was irrational exuberance finally meeting reality. Every commentator who had been skeptical of the silver run suddenly emerged and started explaining with great confidence exactly why this collapse was inevitable. The tone was almost gleeful, as if the crash validated every bearish opinion from the previous months. But here is what every single one of those commentators left out. Since February 6th, silver staged a recovery of 32%. It climbed from $63.85 back up toward $84 by February 20th. The same metal they spent 2 weeks calling a broken story recovered a third of its entire value in 14 days. So either the crash that was supposedly inevitable also produced a recovery that was supposedly impossible, or the narrative being sold to you was incomplete from the very beginning. If you look at the data, honestly, it is clearly the second one. To understand where silver goes from here, you have to build the picture layer by layer. Price alone is like reading the last sentence of a chapter and thinking you understand the whole book. You need the technical structure, the positioning data, the fundamental supply and demand picture, the macro environment, and the relationships between silver and the other assets moving around it simultaneously. Let us start with the technical structure, because that is the foundation everything else is built on. When you look at the daily chart on silver, specifically the XAG-USD pair, what you are watching develop right now is a cup formation. The impulse wave began back in late November of last year and eventually carried silver all the way to $121 on January 29th. That peak represents the left rim of the cup. The crash to $63.85 on February 6th forms the bottom. And the recovery back toward $84 represents the right side of the cup approaching what technicians call the neckline. That neckline sits right around $84. Lock this number into your memory. A clean daily close above 84 confirms the cup structure and opens the door to the next phase, the formation of a handle followed by a breakout. But before we get to the institutional picture, there is a technical signal embedded in the current price action that deserves careful attention. Between February 4th and February 20th, the price itself was forming a lower high. That looks like weakening momentum. But when you look at the relative strength index during that exact same period, it was forming a higher high. The RSI was climbing even as the price was making lower highs. This is what technicians call a hidden bearish RSI divergence. What it tells you is that despite the apparent strength in the RSI, the underlying price trend is leaning toward consolidation rather than an immediate continuation higher. The market is communicating that it needs to pause and build a more stable base before the next directional move can begin. The technical picture right now is saying one thing for multiple directions: consolidation before continuation. Now, let us talk about what the smart money is actually doing. There is on-chain data showing a significant position opened by a sophisticated market participant using a wallet address beginning with 0xACB. This entity deposited $5 million in stablecoin into a professional trading platform and opened short positions on both gold and silver simultaneously. The gold position carries 4 times leverage. The silver position carries 3 times leverage. When you do the math on the exposure, we are talking about nearly 3,000 ounces of gold worth over $15 million and over 97,000 ounces of silver worth over $8 million. This is sophisticated capital with a specific thesis. And that thesis is not that silver is going to zero. What this position communicates is that whoever built it expects prices to consolidate and possibly dip before the next significant move happens. They are betting that the near-term path involves chop and sideways action before the market resolves in its next direction. Understanding the difference between a short-term positioning bet and a long-term directional thesis is one of the most important distinctions any investor can learn. This is a good place to pause and ask you to hit the like button if this analysis is giving you a different perspective than what you have been seeing elsewhere. It genuinely helps more people find this kind of content. And if you have a friend or family member who has been following the silver story, share this video with them right now. Now let us keep building this picture. The levels you need written down right now are these. $75 is the line in the sand for the bullish structure. The handle portion of the cup and handle pattern needs to hold above 75. A daily close below 75 cracks the cup structure and invites a retest of the $71 level. If 71 fails, the cup formation is invalidated, and the next technical support is the 100-day moving average at $69. Below that, the 200-day moving average at $57 represents one of the deepest structural support levels on the entire chart. Write those 4 numbers down: 75, 71, 69, 57. Those are your downside roadmap. Markets move fast, and panic is the most expensive emotional response in investing. Knowing your levels before something happens is the single best tool you have against it. Now here is something that people focused only on spot price are missing entirely. The Global X Silver Miners ETF, ticker symbol SIL, is currently holding above $17. The Miners ETF peaked on January 26th, 3 days before silver spot reached its all-time high on January 29th. Miners led the rally on the way up. But here is what matters for where we are right now. During this consolidation phase, the miners are holding relatively firm. They are not collapsing. They are not giving back enormous chunks of their gains. When miners hold steady while the metal itself consolidates, it historically suggests the next directional move in the metal is likely to be higher, not lower. Mining companies have direct visibility into their order books. They see the contracts being signed with industrial buyers. They see the delivery schedules being confirmed. They understand the physical demand pipeline in a way that spot price traders simply cannot. When these companies are trading with resilience, it tells you something important about what the people closest to actual supply and demand are seeing right now. Now let us talk about the paper market dynamic. The front month COMEX silver futures contract, symbol SI1, is currently trading around $82. Silver spot is trading at $84. Futures are trading below spot. This condition is called backwardation, and it is not normal. Under typical market conditions, futures contracts trade above spot because of carrying costs, including storage, insurance, and financing. When futures trade below spot, it means buyers are willing to pay a premium to get physical silver right now rather than wait for a futures delivery later. They are pricing urgency into the spot market. They are telling you with their actual capital that they need physical silver immediately. Backwardation is not a theory. It is a mathematical reality you can verify yourself by pulling up the SI1 futures price and comparing it directly to ZAG USD spot. The numbers are public, and what those numbers are showing right now is that somewhere in the supply chain, there is urgency around physical silver strong enough to pay a premium over futures. But here is the important nuance. Open interest on SI1 has been declining steadily since February 6th, even as the price climbed from 63 back toward 82. Rising price with falling open interest is the signature of a short covering rally. After the crash, traders who had positioned short found themselves sitting on enormous profits. As silver recovered, those short sellers started buying back their positions to lock in gains. The buying pushed the price higher. But this is not the same as fresh committed capital entering the market. It is old positions being unwound. Once those short positions are fully covered, the price needs new buyers to sustain momentum. Based on the declining open interest data, that short covering fuel appears to be running low. The next wave of fresh institutional buying has not yet arrived. Understanding that transition from short covering to fresh buying is absolutely essential to managing your expectations for the near term. Drop a comment right now. Did you know about the backwardation in silver futures before watching this? I want to know how many people following the silver story have been tracking that specific data point. Let me know below. The Commitment of Traders report, published weekly by the CFTC and available to anyone who wants it, shows that managed money, which includes professional hedge funds and commodity trading advisors, currently holds a net long position of just 5,472 contracts in silver. During the rally to $121, hedge funds were positioned at multiples of this level. Then the crash happened, those positions got flushed out, and now those same hedge funds are sitting on the sidelines with minimal exposure, waiting for something specific before they commit their capital again. A reading this low is simultaneously one of the most bullish medium-term signals you will find anywhere in the current silver analysis, and the clearest explanation for why near-term consolidation is the most probable path. Hedge funds sitting on the sidelines means there is an enormous pool of capital that has not yet been deployed into silver longs. When these institutional participants decide the setup is right, the buying they bring into the market will be substantial. We are talking about the potential for tens of thousands of contracts flowing into the long side in a compressed time frame. But these sophisticated investors are not going to chase a market that just came off a 47% crash. They need to see a clean breakout above $91 to $92 before they step back in with meaningful exposure. Until then, without their participation, the market consolidates. Drop your location in the comments right now. Are you watching from the East Coast, the Midwest, out West? I want to see where this community is spread across the country. And if you know someone who has been asking questions about silver recently, share this video with them right now. The US dollar index is sitting above 97. It has been climbing steadily since February 11th. When the dollar strengthens, it creates downward pressure on dollar-denominated commodities. That is a headwind. And right now, the dollar is generating that headwind. But here is what makes the current setup so fascinating. Since February 17th, silver has been rising alongside the dollar, not against it, with it. When silver rises, despite dollar headwinds, it means the underlying demand for the metal is strong enough to overwhelm the currency mathematics. That kind of demand does not come from speculation. It comes from necessity. It comes from buyers who need silver regardless of what the dollar is doing. The dollar closed the most recent Friday at 97.75, tracking for its strongest weekly performance since October. Capital is flowing into dollar assets broadly, and silver is rising anyway. Real physical demand is overriding the currency headwind. That is the signal. The gold-silver ratio, symbol ZOXAG, is currently sitting at 60. The ratio has been declining since February 17th, meaning silver has been outperforming gold. Silver outperforming gold tends to signal a risk-on environment where investors are comfortable with the more industrial, more volatile metal. But here's the risk embedded in this ratio. It is forming what looks like a bullish flag pattern. If that flag breaks out to the upside, meaning the ratio climbs rather than continues to fall, it signals that gold reclaims performance leadership. The market rotates from silver's industrial appeal back toward gold's safe haven characteristics. That rotation tends to cap silver's upside momentum and can trigger a meaningful pullback. This risk is live and visible in the data right now, and any serious analysis of silver in March that does not mention it is giving you an incomplete picture. Here is the full scorecard. 4 indicators lean bullish. Miners are showing relative strength during consolidation. Backwardation in COMEX futures confirms physical demand urgency is real. The dollar-silver divergence shows genuine underlying buying pressure strong enough to overcome the currency headwind. And the KOT data shows hedge funds are barely positioned with a massive pool of institutional capital waiting on the sidelines. 3 indicators urge caution. Declining COMEX, open interest signals. The short covering rally is running low on fuel. The hidden bearish RSI divergence suggests consolidation before continuation. And the bullish flag in the gold-silver ratio represents a live risk of momentum rotating back toward gold. 4 tailwinds, 3 caution signals. This is a carefully defined setup with specific levels and a specific probabilistic path the evidence points toward. On Monday, February 23rd at 8:30 Eastern, Christopher Waller speaks in Washington. Any language hinting at a dovish posture would be broadly supportive for silver. Any reinforcement of keeping rates elevated would create pressure. On Tuesday, February 24th at 10 Eastern, consumer confidence data drops. When confidence falls sharply, it signals headwinds for the broader economy and for silver's industrial demand story. And on Friday, February 27th at 8:30 Eastern, the producer price index releases. A strong PPI print tends to raise concerns about persistent inflation and create selling pressure in silver. A weak print goes the other way. Know when these numbers come out and know what economists are expecting going in. Tariff escalation creates supply chain uncertainty for manufacturers using silver as an industrial input and generates market volatility that can push silver prices sharply in either direction. The Supreme Court of the United States weighed in with a 6-3 ruling on related questions, and Treasury yields moved in response. The The most recent core PCE reading came in at 0.4% for December, pushing the annual core rate to 3%. With January PCE data due on March 13th, economists are flagging that December's stronger print may delay the next Fed rate cut until after June. Silver pays no yield. When the rate you can earn on a Treasury bill is high and likely to stay high, the opportunity cost of holding a non-yielding asset increases. That is a headwind worth monitoring closely. Now let me give you something most silver bulls do not want to sit with. There's a real long-term demand risk building around silver's role in the solar energy industry. The solar sector accounts for roughly 17% of global silver demand. But silver is also the most expensive component in manufacturing solar panels, and that creates a powerful economic incentive to find alternatives. Manufacturers are actively working to substitute copper for silver in photovoltaic applications. Derek Schnee, a senior commercial solar consultant at JK Renewables, has publicly stated that silver is the greatest single contributor to the increased cost of manufacturing solar panels. That statement from someone inside the industry tells you the conversation about substitution is not theoretical. It is active and economically motivated. The higher silver prices go, the more compelling the business case for substitution becomes. The incentive structure is in place and growing. Ignoring this risk because it is inconvenient to the bull case is not analysis. It is wishful thinking, and wishful thinking is very expensive in financial markets. Additionally, the 47% crash left behind a significant number of what traders call trapped longs. These are investors who purchased silver at elevated levels and are now sitting on substantial unrealized losses. Many of them will look at any significant rally as an opportunity to exit at reduced losses, rather than holding on. That selling pressure creates overhead resistance the market has to absorb before it can mount a clean, sustained move higher. And the bearish scenario gains traction under specific conditions. If the dollar index surges above 100, the currency headwind becomes too significant to overcome. If the gold-silver ratio decisively breaks its bullish flag and pushes towards 70, rotation back to gold pressures silver. And if upcoming data reinforces the higher for longer rate narrative strongly enough to crush near-term rate cut expectations, silver faces institutional selling. These are real risks. The investors who get into serious trouble are the ones who build one-sided cases and only listen to arguments confirming what they already want to believe. Markets do not reward confirmation bias, they punish it. But here is the crucial counterpoint, grounded entirely in observable, verifiable public data. The backwardation in COMEX futures is a market condition you can verify yourself right now by comparing SI1 to ZAG-USD spot. The miners holding firm is observable price action in companies with direct visibility into the physical demand pipeline. And the COT positioning data, showing managed money at just 5,472 contracts, is a weekly snapshot from the CFTC itself, showing exactly how much institutional capital is sitting on the sidelines. Pull up the CFTC website and look at the COT report yourself. Pull up the SIL chart and compare its peaks and troughs against silver spot yourself. The data is there for anyone willing to look at it directly. The most probable near-term path for March is a consolidation range roughly between $75 on the downside and $92 on the upside. The market builds a base within that range. A clean daily close above 84 confirms the cut formation neckline. A push above 91 to 92 validates the full technical breakout and would trigger the institutional participation that has been absent during this recovery phase. Once that institutional buying flows in with rising open interest confirming it is fresh capital, the path toward $100 opens. $100 is not just a price level. It is a psychological milestone that generates its own momentum and attracts investors who have not been participating. Extended targets of a retest of the January all-time high at 121 and a Fibonacci extension at 136 become realistic if the rally sustains into mid-March, with rising open interest confirming institutional participation. But those targets require confirmation at every step. The downside roadmap stays the same. 75 is your line in the sand. Below that, 71. Below that, the 100-day moving average at 69. And the 200-day moving average at 57 represents the deepest structural support on the chart. Before you have any exposure to silver, you need to know which of these levels represents your exit criteria. Not after something starts moving, before. When markets move fast, the time between a level breaking and an emotional decision being made can be measured in minutes. This is what separates investors who build wealth in volatile markets from the ones who give it back. Preparation. The clear-eyed decision made in advance about exactly what conditions would tell you that your thesis is wrong. That is the standard at Element Axis. Not telling you what to think, teaching you how to think, building the frameworks and pattern recognition that make you a more independent, more capable investor over time. If that is the kind of investing education you want, hit subscribe right now and turn on notifications. Every analysis here is built the same way. Data first, structure first, multiple perspectives, clear levels, no hype, no agenda. Just the raw information and the frameworks to interpret it. Here is the bottom line. Silver crashed 47% from 121 to 63.85 in 8 trading sessions. It recovered 32% back toward 84 in 2 weeks. The cup formation is developing with the neckline at 84. The handle needs to stay above 75. The breakout level is 91 to 92. The path to 100 opens above that. On the downside, your levels are 75, 71, 69, and 57. Know them before you need them. 4 indicators lean bullish. 3 urge caution. The macro calendar brings Waller on Monday, consumer confidence Tuesday, and PPI Friday. The consolidation happening right now is not the end of the silver story. It is the pause that builds the next chapter. Drop a comment right now. Tell me where you're watching from and which data point hit you the hardest. Was it the backwardation, the hedge fund positioning, the miners' leading signal, the dollar divergence? Hit like if this gave you a cleaner picture of where silver stands. Share it with anyone in your circle trying to make sense of what happened over the last 30 days. And subscribe to Element Axis if you want this kind of structured, data-driven analysis delivered consistently without the noise and without the hype. The primary sources are public. The data is available. The ones who look find exactly what the numbers show. See you in the next one.